The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A beautiful shot of London this morning. You'll notice no planes in the sky at this point. Welcome to Squawk Box. I'm Karen Cho with Juliana Talabam. These are your headlines. Chaos at London's Heathrow Airport. All flights in and out cancelled or diverted after an electrical fire knocks out power to the airport and thousands of homes nearby. US equity markets once again under pressure, even with the Dow and S&P 500 on pace to eke out small gains for the week. DoubleLine Capital's Jeffrey Gundlach says he's pricing in a recession.
I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
The EU delays retaliatory tariffs on the U.S. by 2 weeks to mid-April, pushing for more talks with President Trump's administration. And German shipping giant Hapag-Lloyd posted a 19% slide in full-year profit as the group's CEO warns of tariff uncertainty.
The impact of tariffs is also difficult to predict. There are definitely multiple factors that play a role there, but by and large, tariffs are not good for global trade, and we also don't think they create a lot of wealth over time.
Nike fails to impress. The sneaker giant warns of plunging sales in the current quarter as weak consumer confidence and tariff uncertainty take a toll. A big domestic story unfolding today with international consequences. London's Heathrow Airport is closed, with major disruption expected to last for days. The airport and around 16,000 nearby homes are without power due to a large fire at a substation. According to tracking site Flight Radar 24, more than 1,350 flights will be directly affected today, including at least 120 inbound flights in the air, which have been diverted. In a statement, the airport said it was left with no choice but to shut down operations until at least midnight tonight and urged passengers to stay away. Heathrow is one of the world's busiest airports, handling more than 229,000 passengers a day last year, with the plane taking off or landing every 45 seconds. Well, we've flown in and out of Heathrow many times, and we can both testify to the fact that it's incredibly busy. But this story does bring to the heart the resilience of the UK. You have a major hub internationally, and it's brought down by a fire. And this is, of course, not right on premise, but a little bit further away. And what we're hearing about this morning, diversions to all sorts of places. Shannon in Ireland, of course, a bit closer to home to Gatwick, but across to Paris, even Washington, D.C. So you're seeing scrambling internationally to make sure planes are landing on the ground.
Well, I think it's a great point. And you open by saying this is a big domestic story. And I would argue this goes far beyond London, given all of the changes that will have to happen on the back of the closure of Heathrow. And it's a massive number of passengers affected, 145,000 passengers set to be affected. I've got some firsthand experience. I've got family in London this morning. Their flights canceled, and the airlines themselves haven't even been able to catch up with the news. There's no airlines this morning, no notifications to passengers whose flights were canceled, given the unexpected and unprecedented nature of this closure. To say at this stage that the airport's going to be closed all day, that's a huge, huge disruption.
That's right. At this point, they're not scheduled to reopen until almost midnight tonight. BA itself has about 341 flights scheduled to land at Heathrow today, so one of the main airlines in and out of this hub in West London. So I think we're going to be watching developments very, very closely. And of course, this fire, which has been impacting local residents as well. So it does tell you about how tenuous it is to keep operations together and whether you can knock out a major operation with one single impact. And then, of course, an era of cybersecurity as well. This again highlights the challenges of ensuring ensuring that operations run smoothly.
Yeah, it also puts the expansion plans firmly into focus.
It does.
Be tricky
it does.
when Heathrow already operates at capacity. There's obviously those very controversial plans about building a third runway. Well, let's move on to markets. U.S. equities yesterday ended the day lower. The Dow Jones, the S&P, and the Nasdaq all ending in negative territory. The Nasdaq pulling back by about 0.33%. We saw the consumer discretionary, tech, communication services, and materials all more than 10% off of their 52-week highs now. In terms of bond markets, here's a picture of treasuries and where we sit as we open up the final day of trade this week. You've got the 10-year trading around 4.25%, the 2-year trading just under that 4% mark. Dollar crosses. We are looking at right now the euro trading on the back foot versus the dollar yesterday. The dollar index gained about 0.33%. You've got sterling also trading weaker versus the greenback by about 0.33%. We're just hovering below that 130 mark yet again. Moving on to commodities, here's where gold is trading this morning. It's on the back foot a little bit, about 0.5% lower. WTI and Brent both trading higher this morning. In the overnight session, Asian equities, we are in the red for the most part. The Hang Seng pulling back by about 2.5%. Shanghai Composite in China also trading on the back foot, down about 1.4%. A bit of green on the board, though, over in Korea with the Kospi trading marginally higher. Jeffrey Gundlach is warning of more risks to come. Speaking on CNBC's Closing Bell, the DoubleLine Capital CEO said investors should have already upgraded their portfolios to weather the heightened risks of a recession. Take a listen.
I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters. The tariffs could very well be inflationary, and the inflation rate is going higher anyway because of the base effects of what's rolling off from last year. And so I think they just downgraded GDP, so we're getting closer to recession.
The European Union will push back its first round of retaliatory tariffs against the US by 2 weeks. The bloc's plans to impose tariffs on 26 billion euros of American goods will now come into force in the middle of next month. An EU spokesperson told CNBC the additional time will allow for further talks with the US while addressing the interests of European businesses and consumers. Susanna Streeter joins us now, head of money and markets at Hargreaves Lansdown. Susanna, thank you so much for joining us. It was a real connection between Trump tariffs and central banking this week as a ton of central banks weighed in, from the US Federal Reserve to the Bank of England, ECB. We had the Swiss National Bank as well, all talking about the uncertainty that we're now facing because of these tariffs and some of the policies from Trump. How do you piece this together for markets and sort of certainty that you can put onto risk assets when even the Fed can't see the horizon?
Yeah, maelstrom of uncertainty that central bankers are having to deal with, and that was absolutely clear from the decisions that we had this week. And the Bank of England made that clear yesterday. And in fact, there was an about turn from a number of policymakers who had voted for a deeper interest rate cut last month, but actually now a slightly weaker one, and one actually voted for the rates to be kept on hold. Catherine Mann had wanted a much deeper cut. It just actually shows about the level of uncertainty and how right now, I think the comment previously made that actually investors should already have been looking at their portfolios. We have seen that happen to a great extent. For example, the HL Investor Confidence Survey shows a real upswing in confidence for the European sector and 18% fall in confidence in North America. And of course, the Bank of America survey shows that already fund managers have been making bigger adjustments to portfolios. And I think what we will expect, even though we've just heard about this delay to tariffs perhaps from Europe, is that there is going to be a lot more volatility to come. We haven't felt the effect of these tariffs yet on the global economy properly. So I would stay certainly in a buckle up your seatbelt mode.
To me, there are a lot of comparisons even to the COVID era, exogenous shock that we're facing, whether we've got transitory effects on inflation as well. I mean, very different circumstances.
Yes, transitory effects. What does that mean? How long would the transitory period go on for? I thought perhaps that choice of words was unusual that we heard from Jerome Powell, because we have, for example, there was a large shipping conference, the European Shipping Summit yesterday, and just the impact of tariffs on Chinese manufactured ships in ports in the United States. a fine of $1.5 million per visit, well, that's going to have a big impact on the price of consumer goods in the United States, because it would be passed through in higher port fees and then onto manufacturers. So I think that actually we could be in line for a greater inflation shock than the markets are actually currently pricing in.
But here in the UK, the Bank of England is contending not only with geopolitical uncertainty, trade uncertainty, but also dealing with the fact that tax hikes are going to start coming in from April. And that is going to invariably put pressure on companies, raise labor costs, and potentially close the window in which the Bank of England can cut rates if they're going to see services inflation start to tick up again. So when is the window actually closing for the Bank of England if they want to push through another rate cut?
But actually, that a lot of that has already been priced in, and we're having some kind of conflicting reports back from retailers about how they are going to deal with this increase in national insurance contributions. We have had a down growth from the OECD for the UK for this year, but certainly I do expect that there will be a number of rate cuts this year. Although there is this wait and see approach right now, but overall I think that will still be the direction of travel, and I don't necessarily think the window is closing really rapidly. We don't exactly know how these will be passed on, but it could well be in slower wage growth, which actually the Bank of England would want to see anyway.
What about China? It feels like right now the market is really trying to understand how the Chinese consumer is doing. The Chinese government has pushed through this plan to try to get consumers spending again in China, but the jury's still out as to whether these new initiatives are actually going to be effective.
Yeah, it did actually lift stocks a little bit at the start of the week, but certainly Chinese consumers are extremely reluctant. Not really a surprise given how the property market has been hit with such a slump, really affecting wealth perceptions. So it's going to take time to turn around, but certainly there were more measures put forward this time, more concrete measures to help the consumer, particularly, for example, even help with kind of student loans and pensioners, to give them this extra security blanket so that they don't feel they have to save quite so much in the future. But I do think it's going to take time to tick through. But when we talk about wealth perceptions, given the volatility within the US stock market, I do think that's going to help start to affect wealth perceptions of Americans, and that could actually exacerbate this slowdown in growth that's already been flagged by the Fed.
You just mentioned a couple of different words there about perception, security. I mean, I could use all this and wrap it up in a Heathrow story this morning, which is our number one story. And it's hard to see how this extends to become necessarily a market story, even though it's a business story and potentially even an economic story, because to me, it again shines a light on what type of infrastructure we have in the UK, just as the Europeans are talking about throwing more money in infrastructure and defence and ensuring they have a game plan or working from the same page. With the UK, we know, has challenges from every twist and turn. The government is trying to address that, but still the challenges are great. And I wonder again, as we look at this story, it's one incident that's taken out an entire airport for 24 hours pretty much. I mean, this is a huge turn of events, and you've got to say, how is that possible that there isn't enough resilience that one event can cause this type of trauma?
Absolutely. It's fourth largest airport in the world. Had record numbers of passengers last year, something 89 million. And yes, it will be a huge concern for the government, but I think it does actually bolster their strategy really for ring-fencing more funding for infrastructure and for trying to make the UK more resilient. Remember, stability is really the cornerstone of what the UK government is trying to do at the moment, which is why it's increase the taxes on businesses to try and balance the books. It wants to be seen as stable. And so there will be this greater, I think, emphasis on ring-fencing perhaps the National Wealth Fund to support infrastructure projects. We have had problems, of course, with planning decisions. They're trying to railroad all of those, but I think this will give it added impetus.
Susanna, can we come back to markets here? It's been obviously a really volatile few weeks for equity investors, and a lot are wondering whether we've seen the bottom. Do you have advice or sort of strategy for investors trying to call the bottom for markets?
I think that's a very difficult call. Trying to catch a falling knife can end in tears. And I think the best strategy right now is to make sure you are well diversified. And particularly if you want to invest in a global portfolio. Make sure that it's not overweight, perhaps towards the United States at the moment, and certainly make sure that you do have various streams throughout your portfolio, because of course I don't think we may have seen the bottom right now, because as I said at the beginning, we haven't yet seen the impact of tariffs. And right now the US administration doesn't appear to be concerned about the market falls that we've seen, and is seeming to be given the green light to further tariffs, which may impact global growth and certainly US economic growth going forward. And that, I think, is going to affect market sentiment even further. So it's really important that you are very well diversified right now.
It's fascinating, very old-fashioned market in a way, isn't it? We used to talk about to catch a falling knife, and then in recent years, a little bit of FOMO has kicked in every time there's been a dip, and markets have quickly again moved back up again. So it feels like the old days when we talk about that uncertainty coming to the markets and further sell-offs potentially.
Yeah, and that FOMO is really crucial, because so many US households have been swept up into this FOMO, pouring so much of their savings into the stock market. So this is likely to be very unsettling, I think, and could make consumers even more cautious about spending in the US.
Susanna, thank you so much for joining us this morning. First up, 6 a.m. on a Friday morning, Susanna Streeter with us, Head of Money and Markets at Hargreaves Lansdown. You can read CNBC's full interview with Jeffrey Gundlach at cnbc.com.
In the wake of Wednesday's Fed decision and Jay Powell's tariff warning, we'll be hearing from the Chicago Fed President Austin Goolsbee. That exclusive CNBC interview is coming up at 12:30 GMT today. Coming up on this show, return to sender. Shares in FedEx and Hapag-Lloyd slump as tariffs and economic uncertainty weigh on the logistics firm's forecasts. Plus, Ukrainian President Volodymyr Zelensky readies a trip to Paris as NATO reportedly looks to prepare for a post-American future. And we'll speak to the CEO of steel giant Salzgitter as tariffs loom on the horizon. Don't miss that conversation coming up at 7 o'clock. Welcome back to Squawk Box. Shares of FedEx closed more than 5% in the red after the firm missed expectations for the third quarter profit and cut its full-year guidance, warning of weakness and uncertainty in the U.S. industrial sector. Frank Holland filed this report.
FedEx shares moving lower after a beat on revenue but a miss on EPS. The company also lowered its full-year revenue and EPS guidance. Two things that are important to note there. There's only one quarter left in the fiscal year. Also, FedEx said that reduction in guidance did not include any potential impact that could come from April 2nd reciprocal tariffs being instituted by the Trump administration. Again, those reciprocal tariffs coming on April 2nd. The company said their guidance did not include any potential impact related to those. CEO Raj Subramanian called it a challenging environment right now. The company's CFO also talked about uncertainty weighing on results. Now, the Express segment, that did outperform expectations. Remember, this actually covers the holiday season for FedEx, this current report. However, the freight segment really underperformed overall. The CFO saying uncertainty when it comes to the manufacturing industrial sector really weighed on that segment. A key data point for that segment. When it comes to the pounds per day that the freight segment is moving in the United States, that actually declined 60% year over year, just speaking to some of that uncertainty. So again, FedEx shares lower after a beat on revenue but a miss on EPS, also lowering its full-year revenue and EPS guidance, but saying that cut in guidance does not include any potential impact of coming tariffs.
Shares of Hapag-Lloyd closed sharply lower after the German shipping firm reported a near 19% drop in 2024 net profit and warned of a further decline this year amid US tariffs and Houthi attacks in the Red Sea. Annetta spoke to the CEO and asked how the firm is navigating the trade turmoil.
I mean, making specific calculations is difficult, but of course, tariffs are never good for global trade. Yeah, so as such, that's why we are definitely against that. The impact of tariffs is also difficult to predict. If we look at the first Trump administration, then there were a lot of tariffs being implemented, for example, in the trade to the US. Under the Biden administration, it was similar, yet we have seen a pretty good development of global trade in that period. So there are definitely multiple factors that play a role there, but by and large, tariffs are not good for global trade, and we also don't think they create a lot of wealth over time. So, we always try to do whatever we can to convince people not to impose tariffs, because we believe that over time that's the best for the world.
Being a Germany headquartered company, do you think you might actually face difficult treatment in the US, given that the US administration is preferring their own companies?
I mean, when you look at container shipping in particular, I mean, the number of US-based companies that is active in that trade is fairly limited. And many of the larger companies that are actually not so much German, but most of them European and truly global, they will remain there. And I think we will also over time remain welcome in the US. We also have ships under US flag, actually, to specifically also signal that we support the US, and we have done so over many years. So I don't see any significant change coming there.
Let me just pick up on the back of the shipping commentary, because it is part of a broader blueprint, the MAGA plan from Donald Trump. And effectively, he wants to bring manufacturing back to the United States. And we're seeing that tackled from all different areas around steel and aluminium to rare earths and building more chips. So every little piece of the pie that you could possibly want, he wants back in the United States. The other part of this is if you're building more at home, you want the ability to send it internationally. So he wants shipbuilding to come back. The problem is the route that he sees to achieving that is incredibly disruptive, and it means penalising the Chinese. But the view in the market is that this also penalises a lot of US exports currently. So what we're talking about here, this is a draft from the US Trade Representative, the proposal to levy fines of up to $1.5 million on China-made ships or vessels from fleets that include ships made in China. So pretty much you can weave your way through a fleet internationally, and you can see the impact. About 30% of some of the trade really comes through those Chinese ships. So some are saying, look, if you just do the numbers even on agriculture, it means that US exporters are facing penalties. Some of the Australians are actually tallied up a number saying that would add up to about $26.50 Australian dollars a tonne, based on 60,000 tonnes coming out of a large vessel. So if you start to stack that up, the levies, it does tell you that US exporters might be facing an immediate challenge too, even from a domestic policy.
It's fascinating to look at the US exporters and potential future US exporters if President Trump has his way. I would say near term, when it comes to the tariff impact, that also stands to be a major disruptive factor for the shipping industry, because we may see a shift in trade flows, and we're already starting to see this as companies reroute their goods in a response to what's happening between the U.S. and other countries, and in preparation for what may happen between the U.S. and EU. We've seen a lot of front loading from companies, and that will obviously be positive near term, but what happens once that front loading, that stockpiling is done from an inventory perspective? What happens to the shipping industry, because we're obviously going to see a pullback then. But it's interesting, it's not all negative for the shipping industry. It doesn't necessarily mean that we're going to see a reduction in trade flows in absolute. It just may mean that we'll see a diversion of goods that were once destined for the US to come to places like Europe.
Well, we have seen this show before, haven't we? And again, we were talking about COVID comparisons, which is just extraordinary because this is so different to a pandemic. But the impact on supply chains here, where we saw during the COVID era that there were distortions in the market, meant prices went up by a huge amount, and that obviously had an impact on consumers and, of course, inflation. What we're talking about now, whether it's goods coming in or out of the United States, we're talking about some sort of a hit here that has a knock-on consequence to the price action for the shippers, and then, of course, that ends up being paid by the consumers. Even Nike yesterday was talking about 24% of its suppliers and manufacturers are located in China. So this is an area where, don't forget, consumers have loved buying a lot of athleisure wear in recent years, something that consumers could feel the hit of. And Nike even yesterday was talking about whether it's the suppliers, manufacturers, whether they take the hit, whether Nike takes the hit, whether consumers take the hit. Even if you split it, somebody takes the hit. And I think when we talk about the stock market, investors, and this is really goes to the heart of what they've been doing, have been de-risking from the US because they think far and wide these tariffs could impact investors in various different stocks.
And it's very unclear, I think, as you say, where the bulk of these costs are going to be borne. Will we, back in 2018, if we look at that playbook, we saw a lot of companies who were coming into this from a position of strength absorb higher costs, and they didn't pass on the bulk of the cost to consumers. This time round, companies not in as strong a position. We are not sitting on the back of a major tax relief package in the U.S. Trump hasn't done that yet this time round. So companies in a very different position, and I think the market is positioning for companies to pass on these higher costs to consumers ultimately.
To me, what was fascinating was that the market was somewhat relieved this week when it saw that it still had the prospect of 2 rate cuts coming.
Absolutely.
But if you look at the commentary from Jay Powell, why would you be banking on that? Saying, what would you write down when making projections in this environment? That was the quote. I mean, so they haven't changed their forecast, but I think they're by no means certain that they can see that the growth story that they had intact or the inflation projections are going to remain the scenario. So in that case, why would anyone feel relieved on the stock market and around risk assets? Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.